Get your free copy of the complete tutorial at www.teachucomp.com/free.
The terms debit and credit are some of the oldest accounting terms used. They first appeared in the second of a set of 5 mathematics books, roughly translated as everything about arithmetic, geometry, and proportions, written by Luca Pacioli in 1494. The word debit comes from the Latin debeo, which means I have or keep for someone. Credit comes from the word credo, which means I commit or consign to someone. Given that these terms have been in use for over 500 years now, it's doubtful they will change anytime soon. So let's get a better understanding of them and how they are used in the double entry system of accounting. When you record the information for a financial transaction, it is called an entry. When you make an entry, you have to enter both the debit side and the credit side of the entry. The total debit amount must equal the total credit amount in an entry and affect at least 2 accounts. Each account in the general ledger has a debit side, or a left, and a credit side, or a right. Debits and credits are part of keeping the fundamental accounting equation in balance. The accounting equation states that the total assets always equals the sum of the total liabilities and the total equity. And that's what's reflected in our balance sheet. So all asset accounts naturally have a debit balance, and all liability and equity accounts naturally have a credit balance. One way to begin finding debits and credits in a transaction is to identify the 2 components of each transaction. First, what did you get? And second, where did it come from? The debit is what you received, and the credit is the source of the item that you received. For example, assume you purchased a computer with your credit card. The computer is what you received, the asset, and the amount paid came from a credit card, which is a liability. When entering the transaction, you would debit the computer's asset account and credit the credit card liability account for the same amount to create the basic double entry transaction. Another example would be the purchase of miscellaneous office supplies. Let's assume that you wanted to record the fact that you wrote a check to buy $50 worth of paper for the business. In this case, since the paper would not be listed as a fixed asset, we would attribute it to an expense account like office supplies. So the debit would go to the office supplies expense account for $50, and the credit would go to the checking account for $50. The double entry system provides checks and balances to ensure that your books are always in balance. In double entry accounting, every transaction has at least 2 entries, a debit and a credit. As we just discussed, debits must always equal credits. Because debits equal credits, double entry accounting prevents some common bookkeeping errors. In addition, the errors that are made become easier to find. Double entry accounting is the basis of a true accounting system. In double entry accounting, rather than using a single column for each account and entering some numbers as a positive and others as a negative, we use 2 columns for each account and enter only positive numbers. Whether the entry increases or decreases the account is determined by choice of the column into which the value is entered. Entries in the left column are referred to as debits, and entries in the right column are referred to as credits. Visually, it can be helpful to show the account as the letter T, with debit values to the left and credit values to the right. 2 accounts are always affected by each transaction, and one of those entries must be a debit, and the other must be a credit of the equal amount. In many transactions, more than 2 accounts are used. However, the same rule applies to these transactions. The sum of the debits for the transaction must equal the sum of the credits for the transaction. Whether or not an account is increased or decreased by a debit or a credit value depends on the account type. A debit entry will increase the value of some types of accounts while decreasing other types of accounts. The same applies to credits. Understanding how debits and credits affect the various account types is critical to good bookkeeping. The main account types used are assets, liabilities, equity, income, and expense accounts. We will now show the accounts and how they are affected by debit and credit values, organized by the financial statements in which they appear. On the balance sheet, we find the assets, liabilities, and equity accounts. For assets, debits increase and credits decrease. For liabilities, credits increase and debits decrease. Also for equity, credits increase and debits decrease. The profit and loss statement is where the income and expense accounts are. For income accounts, credits increase and debits decrease. And for expenses, debits increase and credits decrease.
Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.